Hello, and welcome back to week 10 of the No BS Homebuyer Live series. This series is all about breaking the home buying process down into simple weekly steps so that you can go from curious to confident about buying a home. So, over the last few weeks, we have talked about saving, we've talked about paying off debt strategically, and getting financially ready to buy. But today we're going to decode something that confuses a lot of buyers when they start researching, and that is home loans. So I like to call this the loan alphabet soup because home loans love to use acronyms. FHA, VA, USDA. Conventional is the only one that doesn't actually have like a 3-letter, 4-letter word. And then we are also going to talk a little bit about down payment programs and special occupation programs. So to understand all of these different things kind of feels like you need a translator to be able to break it down and like even know what's talking about what. So we're going to keep it simple today. That is our goal, and to understand what these loans actually are and who they are designed for. So these loans are not rewards for perfect finances. They are just tools built for different buyers. So let's talk a little bit about why different loans exist. And really, that's just because different buyers exist. Not everyone has the same financial picture. Some buyers have smaller down payments or lower credit scores. Some people are veterans. Some live in rural areas. And some are coming back to home ownership after renting for a while. And there are loan programs for all of these situations and all of these people, and not all of them are the same. So instead of asking which loan is best, the better question is actually which loan fits my situation best. So let's dive into a couple of them so we can understand the different types of loans, and maybe if you're looking to buy a home, which loan category you're going to fit into best. We're going to start with conventional loans. This is probably the most common type of loan, and the loan where you probably heard the myth that you need 20% down. So these are not backed by the government. Conventional loans are not. They are issued by lenders, but they follow specific guidelines, which are set by Freddie Mac, and Fannie Mae. So pretty much under any lender you go to is going to have to follow these guidelines if they're doing a traditional conventional loan. Typical features of a traditional or a conventional loan, you can do a down payment as low as 3%. I would say in most cases a 5% down makes more sense than a 3% down. But again, most commonly heard in public is 20% down, which is great. And if you do that, you don't have to pay mortgage insurance. If you go under that 20%, you will have to pay mortgage insurance. But the good thing about a conventional loan is that it can eventually be knocked off, or you can do kind of a relook at your equity to get the mortgage insurance dropped off. These conventional loans are able to do more flexible properties. So if you have a property that is in a bit more of disrepair, you are going to have much better luck with a conventional loan versus some of the other ones. Typical credit scores for a conventional loan are usually a little bit higher than maybe the other programs. So a 620 minimum, but if you have like 680 or above, you usually get better terms. So just something to consider with conventional loans. These are often really great for buyers who have decent credit, steady income, and have some savings. So probably the traditional thought of a home buyer is a conventional loan. Let's tap into another type of loan, which is FHA loans. FHA loans are extremely common for first-time buyers. These are backed by the Federal Housing Administration. So this is a government-backed loan. What does that really mean? It does not mean the government is lending you the money. What it means is the government insures the loan for the lender. So if a borrower were to default, the government insurance um, helps protect that lender so they're not losing a bunch of money. And because the lenders have these protections is what allows them to do certain things and kind of open it up to a bigger buyer pool, including people with lower credit scores, smaller down payments, higher debt to income ratios. Typical features that you're going to find with an FHA is a 3.5% down payment. And I would say a lot of people that are doing an FHA loan are doing that 3.5%. Credit scores can be a little bit lower, so you can have like 580 or above. Mortgage insurance will be required, and that's just part of these loans, and it doesn't drop off like a conventional does. You, in most cases, have to just refinance out of it. So these loans work really well for buyers who are new to credit or have very little credit history, or they have lower moderate scores and smaller savings, because you can do that 3.5% down. Now let's touch on the VA loan. VA loans are actually probably one of the best loan programs available. They are available to a very limited group though. They're available to veterans, active duty military, National Guard reserves, and sometimes surviving spouses. Kind of depends on your eligibility. But the typical benefits of a VA loan is you can often do 0% down. I've actually had a VA buyer get a check when they closed, which was kind of exciting. But there is no monthly mortgage insurance and very competitive interest rates. So how do you know if you qualify for a VA loan? The VA determines the eligibility based on the service history and the length of service, but lenders aren't the ones to verify this themselves. Instead, they ask for a document that is called a certificate of eligibility. This just confirms to the lender that the borrower qualifies for the VA loan benefits. You can actually pull your own certificate of eligibility, but probably the most common way is to just have the lender pull it. And then if you want to do it yourself, you can do it through the VA website or through the VA benefits portal. So if you think, you've had some service time, or maybe you're a surviving spouse and there's some service time, it is worth checking to see if you can qualify for a VA loan, because if you can, it really is a very beneficial loan program, because it's like an FHA, but even better because you can do 0% down, but then you don't have all the additional fees, you get a better interest rate, etc. One thing with FHA and VA loans that we tend to run into with issues for buyers is that they do have a little bit more of a strenuous appraisal process. So if you are in a multiple offer situation against a conventional or cash offer, you're going to have a little bit harder of a time getting it accepted, because during the appraisal process on both FHA and VA, they have a bit of an inspection that checks for like safety issues. Probably the most common one that I've seen locally is peeling paint. You can see other things like cracked windows, deteriorating trim, basement issues, missing handrails, things like that. So those can get called. So if you are a seller and you've got a conventional versus an FHA or VA, you're typically going to take the conventional offer over those. So just something to be aware of. Let's talk about another alphabet soup loan, the USDA loan. These are designed for rural areas, but honestly, if you look at the maps all throughout the United States, you will find that the things that are considered rural actually can be quite suburban. So in Nebraska, Lincoln and Omaha are excluded from being USDA loan eligible. However, pretty much every town outside of that is available to use a USDA loan. Key features of a USDA loan are that there are 0% down options, lower mortgage insurance than FHA. There are income limits, so you have to look at your household size and the income limits on the USDA loan in your area. And then it just has to be within an eligible area. So the typical credit range for a USDA loan is like 640 or above is preferred. But again, a lot of suburban areas actually qualify for USDA, even though like initially everyone always thinks like farmland, small town, something. It's double check the map and see if the area that you're looking in qualifies, because you can do a much lower down payment than a conventional, and may be better than an FHA because the mortgage insurance is lower. So just something to consider and know. So now that we've touched on probably the top 4 types of loan types, we are going to talk a little bit about cosigners. So that is, a cosigner is someone that signs on the loan with you to help you get qualified. It helps to strengthen income and credit depending on who your cosigner is. But the thing is, they become equally responsible for the loan. So co-signing is kind of a thing that we use when the loan process isn't working, the buyer can't qualify for the loan on their own, or we're getting through underwriting and then there's something that comes up and we need an emergency situation. They may ask for a cosigner. It is a very big responsibility because they are taking on the debt with you as the buyer. So you also have to account for their debt. So any of their debts also counts to their qualifications and the debt to income ratio. And then their credit will also affect the loan term. So if you need a cosigner for the income, but their credit is worse than yours, they're going to take the lower credit. And then if you were to miss a payment, that will affect not only you, but it will also affect the cosigner. So co-signing for someone is not something to be taken lightly. A lot of times you will see family members do it for other family members, or parents do it for their children. But if you ever get asked to co-sign, just please remember it is a very big deal, and your debts will then that will count for debt for you in the future if you're going to buy. So this can help some buyers qualify, but it is something that should be really done thoughtfully and with some preparation. All right, now let's talk about first-time home buyers, because everyone always talks about first-time home buyer programs. And there's something that is going to surprise a lot of people. You do not actually have to be literally buying your first home. So most programs will define a first-time home buyer as someone who has not owned a home in the past 3 years. So if you've never owned a home or you haven't owned for the past 3 years, you very may well qualify as a first-time home buyer. A lot of times this happens when you sold a home years ago and you've just been renting. Maybe you moved states and wanted to check out the state or something, and you haven't owned a home. You could potentially be qualified as first-time home buyer. Also, if you've gone through a divorce or you've just been renting for several years. So it is definitely worth looking at first-time home buyer programs, because you can typically find some better interest rates, maybe lower down payment situations. Just worth looking into that to see. And those will vary state by state. So definitely worth checking with a lender that's local and knows your first-time home buyer programs available. Sometimes there will be some sort of grant or like lower interest down payment loan available too. So just every state's a little different, but just know that that's a possibility and what qualifies as a first-time home buyer. And then additional programs to consider varies extremely by state and city and what professions you do, but things to look into would be teacher programs, firefighters, police officers, first responders, and medical professionals. A lot of times there's some type of program that will help those types of professions or careers to buy a home. It kind of depends on the state, but also it might depend on the area that you're looking in. You might have to look in a specific area to get that benefit. But these programs, they may offer like down payment assistance, grants, even forgivable loans. Like if you live there for 10 years, it may just drop off a loan, reduced interest rates, but just something to, again, talk with your local lender to see if it's available to you and for you for your profession. One of the biggest loan misconceptions that buyers make is that they are only going to qualify for one program. And that just might not be true. There could be different loan options available to you. And it's a good lender is going to be able to show you the different scenarios. So you may just initially, like, let's say you go online and you just get qualified. And actually, this just happened to some clients of mine. They just got automatically approved for an FHA loan. And I was a little concerned because they, from what I know of them, they are very financially responsible. So I was like, why are we doing FHA when, first off, you're not like first time home buyers, you've done this before, you have, as far as I know, very good credit, good savings, and everything. So I was a little concerned why they were going FHA. Well, the online lender just kind of spit out something based off of what they entered. However, I had them connect with a local lender because I was a little concerned. I was like, this just doesn't seem right to me. It seems more expensive for them. So the local lender ran the scenario for them with their financials, and they're like, I have no idea why they were trying to put them through FHA. They are conventional, like pristine for conventional financing. So it's really important to have a good lender that can run through the different scenarios. And you could qualify for multiple different ones. And it is worth looking at, the fee breakdown sheet, the interest rate, and all of the factors to really determine which loan program you fit in best. And also, if there's an assistance program that can benefit you as well, you may as well take advantage of it. That's what they're there for. So having a good lender that knows your local area and the local options available to you is really important, so that way you can compare different loan programs that you qualify for. So unless there are any questions, we are going to talk about this week's action step. And it's really quite simple. It is just talk to a lender and ask what type of loans you might qualify for, what kind of credit score range that you're shooting for, are there any assistance programs available to you, and what down payment options exist within these programs for you. You don't have to commit to anything when you're talking to a lender. You are just gathering information, and they are going to be there to help coach you along the way so you have the most success as well. So if you need any recommendations for lenders, please don't hesitate to reach out. I am happy to help connect you with realtors, lenders, insurance agents, wherever you are. So don't feel like you have to do this alone. I am here to help you. And next week, we are going to talk about pre-approvals and what a pre-approval is, like the difference between a pre-approval, a pre-qualification, how to prepare for them, what kind of documents you need and things, and then how to avoid some common mistakes when getting your pre-approval. So if you have any questions, please don't hesitate to reach out. I am just really excited to be doing this, and thank you again for joining the live. And I hope we are breaking this down into simple steps for you so you can go from curious to confident. And I will see you next week. Bye-bye.